Now, with changes in the corporation tax and dividend allowances, does it still make sense to buy a property in a limited company? Let's look at the numbers. Let's say you buy a property worth £100,000 and you have a salary of £30,000. This is how much tax you'd pay if you buy that property in your personal name. Now, let's say you rent this property out for £1,000 a month, you have a mortgage of £350, you have expenses of £200, that leaves a profit of £450. Now, that is normally what you would pay tax on. However, all of that changed in 2016 because of Section 24. Section 24 meant that you could not claim your mortgage as a cost. You could only claim 20% of your mortgage as a cost, and then the rest of it was not claimable. So now, if you rent that property out for £1,000, you can only claim £70, which is 20%, as a cost when it comes to your mortgage. You still have an expense of £200, and that leaves your profit at £730. Now, you haven't made £730, well, you still have a mortgage of £350, but you can't claim the £350, you can only claim £70. And so therefore, you have to pay tax on the £730. So if you make £30,000 a year, this is how much tax you would pay on that. This is what the current UK income tax band looks like. If you make between £0 to £12,570, then that is your personal allowance and you pay no tax, 0%. Between £12,570 and £50,270, you pay 20% tax, which is the basic rate tax. Then between £50,270 to £125,140, you pay 40%, and then anything above that, you pay 45%. So now let's say you make £30,000. Well, on the first $12,570, you don't pay any tax whatsoever. Between $12,570 up till the £30,000 mark, the difference being $17,430, on that amount you have to pay 20% tax like you would do normally with your income. But now your property is making £730 per month, which across 12 months, across the year, is £8,760. Because you have made an additional income of £8,760, when we add that into the income bands, because that amount falls in the 20% range, you have to pay a 20% tax on that amount, which comes to £1,752 a year or £146 per month. So now on that property, before you were renting it out for £1,000, you had a mortgage of £350, expenses of £200, profit of £450. Now you're still renting it for £1,000. You still have a mortgage of £350, expenses of £200, but you also have to pay £146 tax, and therefore your actual profit is only £304. So if you bought this property in your personal name, you'd be making £304 per month. Now, this is how much money you'd make if you were buying this property in a limited company. So now let's assume the same scenario where the property is being rented out for £1,000 and you have a mortgage of £350, but the property is in a limited company. The big difference now is that the entire mortgage of £350 you can count as a cost, whereas in a personal name you can't. So your profit actually is only £450 on paper. You only have to pay tax on the £450, not the £730, which was the case in your personal name. So £450 across 12 months is £5,400. Now, once your limited company has made £5,400, you can pay that to yourself in two ways, through a salary or through a dividend. Actually, aside from a salary or a dividend, one of the main benefits of buying a property in a limited company is the fact that you can have tax-deductible expenses. So you can buy things, like for example this office chair for your company, and that will count as an expense towards your company, and that will reduce your tax bill. And you can do that with other things as well, for example like company car, your phone bill, your laptop, and also office equipment. Now, I've been sent this chair from FlexiSpot, and when it comes to office chairs, it is one of the most comfortable chairs I've ever used. Now, it's got adjustable arms if you want to move this up and down. It also has an adjustable head. Now, my personal favorite feature is the back support and how easily it just goes back and forth. And if you want to stop at a particular angle, you can then stop the chair there. I've used chairs in the past where if you want to go back and you want to stop, you really have to force your back. But this somehow just lightly goes back and forth, which, you know, I personally like. Now, this chair is called a B12 Pro. It comes in grey and black. Right now, there is a huge sale on with FlexiSpot for the month of June where you can get up to 60% off on selected items. So if you want an office chair or you want a standing desk, then click the link in the description below. Thank you FlexiSpot for sponsoring this video, and now back to the tax calculations. Now let's go through the dividend example first. So if your company has made a profit of £5,400 and you want to get that paid out as a dividend, the way dividends work is a company makes a profit, they then pay corporation tax, and any money left over, they can then pay to their directors. So in this case, you've made £5,400 profit, you then paid 19% corporation tax, which is £1,026. Now with corporation tax, because of the tax changes, it is currently 19% corporation tax if you make a profit of under £50,000, it's 25% if you make a profit of over £250,000, and between 50 to 250 there's a marginal rate. It is a bit of a long calculation, but it's somewhere in the middle of the 19 to 25%. In this case, you made £5,400 profit, you pay a tax of £1,026, and now you're left with a post-tax profit of £4,376. That is the amount you can then pay to yourself as a dividend. You've paid all your taxes, that's what you have left, you can then pay that as a dividend. But now there's a further tax, because once you pay yourself £4,374, you have to pay dividend tax. So the current dividend allowance is £1,000. What that means is the first £1,000 you make from a dividend, that is completely tax-free. That used to be £2,000, that has now come down to £1,000. So you deduct the £1,000, and now you're left with a taxable income of £3,374. So therefore, you have to pay dividend tax on the £3,374. Now this is a tax band for dividends. Between 0 to 12,570, once again you pay 0%. Between 12,570 to 50,270, you pay 8.75%. Between 50,270 to 125,140, you pay 33.75%, and anything above that, you pay 39.55%. So now, if you're making a £30,000 salary, that already puts you in the second bracket, which is the 8.75% bracket. On top of that, you now have made an additional income of £3,374. So if we add that into the band, because you're in the second band, you have to pay a 8.75% tax rate on that. So if you're making £3,374, paying an 8.75% tax, well, that's only £295 per year. If we go back to the previous calculation, so now let's say your company has made £5,400 a year. You first have to pay the £1,026 corporation tax. You then also have the £295 dividend tax. That leaves £4,079 per year, or £340 per month. So now with this property, if it's in your personal name, you're making £304 a month. If it's in a limited company, you're making £340 per month. Now you might be thinking, what is the point of setting up a limited company, hiring an accountant, doing all this hassle for the sake of £36? But this is where the real issue comes in. Because of the way income is calculated on personal properties, each property has a taxable income of £8,760. Because in your personal name, you're making £730 per month, which is £8,760. In a limited company, you're only making £450 per month taxable income, which is £5,400. So now let's assume a scenario whereby you don't have one investment property, but let's say you have 4 investment properties. This is where the real problem comes in. Again, you have an income of £30,000, so let's fill up that meter. And each property is making an income of £8,760. So the first property you take on, you make another £8,760. That takes your overall income to £38,760. On that property, you're still paying 20% tax. You then have your second property. You make another £8,760. That takes your income to £47,520. You also pay 20% tax since you're still within that bracket. On your third property, you make another £8,760. Now that takes your income to £56,280. As you can see, now you've gone in to the 40% tax bracket. So anything you make above £50,270, now you're paying 40% tax. On your fourth property, you then make another £8,760. That takes your income to £65,040. That entire property, that entire income on that property, you have to pay a 40% tax because that is the bracket you're in. So on property number 2, when you were paying a tax of 20%, that tax was £1,752 per year. On property number 4, you're paying 40% tax, which is £3,504 a year, or £292 per month. So now, if we go back to the scenario where each property is rented out for £1,000 a month and your mortgage is £350, your expenses are £200. Well, if you then have to pay a tax of £292 on top of that, your income from an investment property is only £158, which is pretty much nothing. And that happens because you're very quickly pushed into the high income tax brackets. However, that doesn't happen if it's in a limited company. Now, with a limited company, your taxable income is £4,374. On the first property, you can claim a £1,000 dividend allowance, and obviously once you claim that, that goes. With any future property, your taxable income will be £4,374. So now let's look at a scenario with 4 investment properties in a limited company. So again, you have your income band. you get to £30,000 because that is your salary, and each property's income, let's say, is £4,374. When you have your first property, you have a taxable income of £3,374. That takes your income up to £33,374, and with that, you're still within that 8.75% tax bracket. On the next property, because you can't claim the dividend allowance, your taxable income now is £4,374. So if we add in £4,374 on the second property, your income then goes up to £37,748. It's still within the same tax bracket. On the third property, we add in another £4,374. That takes your income to £42,122, still within the same tax bracket. If we then add the fourth property, add another £4,374, that takes your income to £46,496, which is still within the same tax bracket. So even on your fourth property, you're only paying a tax of 8.75%. So if you made an income of £4,374 and you paid a 8.75% tax, well, that comes to £383 per year. So in this scenario, if each property made a profit of £5,400, you paid £1,026 to corporation tax, and you paid £383 as dividend tax, you'd still be left with £3,991 per year, or £332 per month. So now if we compare property number 4, in your personal name on property number 4, you're only making £158, but in a limited company, you're making twice as much, as you're making £332 per month. Now the problem really comes in when you cross that £50,000 income threshold, because after that, if a property is in your personal name, you're paying 40% tax. And the issue is, when you own properties in your personal name, because the taxable income is so high, if you have a few properties, you end up crossing that £50,000 threshold, and as a result, you end up paying significantly more tax. Now, if we go back to the income bands, this video was based on you earning £30,000 a year. Let's say you earn £50,000 a year from your job. That already completes the 20% tax bracket. Now, even from your first property, you have to pay a 40% tax. You can't get away with paying 20% for the first few and then pay 40% because you're already in the higher tax bracket. So if your salary is above £50,000, or your combined salary from your properties and your income is above £50,000, then in most cases it's going to be better if you buy a property in a limited company and not in your personal name.